Hi everyone. I'm really pleased to be able to introduce the next speaker, Tom Naughton from Prusik Investment Management. Tom is Managing Partner and CIO of Prusik, and he is Portfolio Manager of the Prusik Asian Equity Income Fund, a fund he has managed since its launch in 2010. Today, Tom's going to talk about Hong Kong and its evolving relationship with China. I think the topic is an excellent way of understanding how markets price risk, particularly in relation to China, and how this creates interesting opportunities for bottom-up active managers. So Tom, over to you.
Good morning. Thank you for having me. I'm Tom Naughton. I'm the CIO, Managing Partner of Prusik Investment Management. We're a Asia equity boutique, and I also run the Asia Equity Income Fund as part of my role here. Today I'm just going to talk a little bit about Hong Kong and China and the relationship between the two of them, because I think in many ways people, merge the two markets, and in my view there's much more there's much more finesse that we need to really, when we talk about China and Hong Kong, we can't just include them together. Hong Kong equities have been a terrible place to be for the last few years. You may remember in the middle of 2019, we had the beginning of the protests or the riots, and that led to a big clampdown in Hong Kong. And then that moved seamlessly into COVID in the early part of 2020. And since then, Hong Kong has really been, in some sort of lockdown for the last 3 years. So straight from political unrest, the implementation of the national security law, which caused a lot of concern in terms of the way that, the power that it gives the Chinese government to prosecute people. Concerns over one country, two systems, that it's just turned into one country. Concerns about the COVID policies, both in China and in Hong Kong, and what that means for Hong Kong operating as a global city. Geopolitics, this big question of, is China uninvestable? Is China in 2022 the same as Russia in 2021? It's just, it's about to be sort of cut off from the global financial system. And then finally, although it's maybe not as big an issue, but Hong Kong also, the mix of companies have been very unfashionable. You can think of it as being a bit like the FTSE 100, lots of sort of conglomerates and banks and real estate companies and companies that just aren't very, haven't been very popular in the last few years. So that's really led to this, huge derating and a huge amount of pessimism about Hong Kong and China. And the question is, does this derating, does this represent the end of Hong Kong? Is that it? We should just sell and forget it? Or is it, a generational buying opportunity? Hong Kong's been through many of these occasions in the past, after the riots in the 60s, after Tiananmen in the late 80s, after, just when I started my career, which was in the few years before it went back to Chinese rule. At each time people say, this is it for Hong Kong, it's all finished, but Hong Kong has shown incredible resilience, and in the past, at times like this, has always been a good opportunity to buy. But of course, there have been significant changes, and so, will Hong Kong become just another Chinese city, in which case it's much less interesting. And for equity income investors, it's particularly interesting because there are a lot of very high quality dividend-paying stocks in Hong Kong. Hong Kong has a very long history in paying dividends. For residents of Hong Kong, dividends are obviously tax-free, and so it's a very efficient way of upstreaming cash, and there's always been a very big dividend culture. Just talking a little bit about dividends, this is just the dividend yield of the Hang Seng Property Index. You can see there right up to the highs. And bear in mind, a lot of these companies, we can find companies that are, investment grade, single A minus rated companies with dividends that are still growing, that are buying back shares, that are trading dividend yields of 4 to 7%, which I think is extremely attractive. And just on the market more broadly, the Hang Seng Index is trading at 0.8 times price to book. Now, I started my career just on the far left of that chart at the peak in 1994, and obviously it's derated significantly since then. But just to put it in perspective, Russia is on 0.7 times price to book, and Hong Kong is on 0.8. So simplistically, we can argue that it's discounting close to the worst case scenario anyway, even though that hasn't happened yet. And again, we can find companies with good business models, paying good dividends that are trading on 30 to 50% of book value. And as we say, outside Russia, it's very difficult to find value like that. When it comes to Hong Kong and thinking about Hong Kong's place in the world and its status, my view is that the concerns, although they're understandable, are misplaced. China needs Hong Kong to prosper in order to access foreign capital. They've made this very clear. We're seeing this now with the ADR listings moving back from the US to Hong Kong. Every policy measure that China puts in place is to support Hong Kong as the offshore financial center for China. And there's really no alternative. Until China have a freely floating currency, they have no capital controls, they have a legal system that people trust, they have no acts, they have no alternative to Hong Kong. And also, China believes a successful Hong Kong is good for future negotiations with Taiwan. Now, this isn't something that people in Taiwan think, but you may remember Hong Kong was actually in a way, the sort of blueprint for Taiwan, this idea that Hong Kong gradually becoming part of China in this one country, two systems was going to be a template they could use for Taiwan. Now, obviously, what's been going on in the last few years, attitudes in Taiwan towards independence or towards, have obviously increased, and people's trust of the Chinese government has decreased. But still, China believe, and I think with some justification, that the more successful Hong Kong is, the better it is for future negotiations with Taiwan. Obviously, they don't want to have to use military force. The more they can do it with showing that Hong Kong can be a success, the better it is for them. And as I say, the Hong Kong dollar peg, I think every few years there's a hedge fund manager that publishes something on the Hong Kong dollar being a short, but I think it's extremely unlikely before the renminbi becomes fully convertible. It's impossible to break because it's a currency board, so it can only be broken by choice. It's not because it's a full currency board. There's no way of breaking it until you need Hong Kong to actually sort of give up. But I think that peg is going to remain. I think that's another concern people have. The other point is Hong Kong, I think, has a lot more autonomy than people realize, although less than it did a few years ago. So on his recent trip to Hong Kong to celebrate the handover, the 25th anniversary of the handover, Xi's speech highlighted the benefits of Hong Kong's differences. In fact, specifically, for the first time I remember him doing, praising the common law system. People can be skeptical about that, given what they're doing on the criminal justice side, but I'll come on to that in a little bit. But I think China can see that it's very useful from a business perspective, having a legal system that if you're doing foreign investment or you're setting up businesses, works extremely effectively, being based on common law. And it doesn't really suit them to get rid of that, to make Hong Kong just like another city, because it comes back to Hong Kong's place in China. It's very important that they maintain those, those things like the legal system that allow it to operate. Also, although people suspected that Hong Kong would just have to follow China's COVID policy, Hong Kong's COVID policy is now effectively moved to living with COVID. They're adding 10,000 cases a day, which would be in UK terms 70, 80,000 cases a day equivalent. So there's obviously, COVID is now endemic in Hong Kong. There's very few restrictions in Hong Kong apart from the quarantine. And so Hong Kong is talking about getting rid of quarantine completely. So in that sense, Hong Kong is being allowed, despite many skeptics, to have a completely different COVID policy. And something else which I think is interesting, that Hong Kong banks abide by the US sanctions. You may remember the US sanctioned a lot of Hong Kong officials, including the chief executive, Carrie Lam, so she couldn't have a bank account in Hong Kong. She had to be paid in bundles of cash. And it's quite incredible to think in what's being part of China, the Hong Kong banks are actually abiding by the US sanctions, even though in China they're forbidden to. So I think it's clear in terms of what's happening, what's being said, the policies that are going in place, that China want to have Hong Kong being separate and having a different amount of autonomy. So the strengths remain intact. The ease of doing business, it's still ranked third in the world in last study in terms of the ease of doing business. Low taxes, very good infrastructure, free movement of capital. Obviously, the COVID restrictions remain a huge issue. We can't pretend they're not. But other than that, a lot of the strengths remain. And in a way, I think, slightly provocatively, as someone I lived in Hong Kong for a long time, when people talking about Hong Kong, moving to Singapore, I think, well, you may have noticed there's not many protests or demonstrations in Singapore. This is a country that has a lot of restrictions on democracy, on free speech and human rights, but is economically very liberal and very free, but obviously controls certain areas very tightly. And I think China wants to do the same thing. When it comes to human rights, when it comes to foreign policy, obviously that will be something that does remain very sensitive. But when it comes to running a business, investing in China, even suing state-owned companies, that will be something that I think will continue much like it does in Singapore. Now, obviously people trust the Singapore government much more than they trust the Chinese government. It's still, we haven't seen whether this will play out in practice, but I think it's underappreciated how likely it is that that will happen. This is just a chart to show Hong Kong's resilience here, and what these charts show are the movement in property prices and then the movement in delinquency ratios. And you can see there, if we look at B and C, you can see the US and Ireland saw property prices fall 30 to 50% and delinquency rates went to this sort of 10 to 12% level when that happened. You can see in Hong Kong where property prices fell by 2/3 and the delinquency ratio went just above 1%. And that's because Hong Kong, because it has a currency board, has always had to operate an extremely flexible economy. It has a huge amount of flex, both in asset prices, in wages, and the banking system and property companies are extremely under-leveraged, which gives it this ability to withstand a volatile situation. So I think it's something that, again, is underappreciated when it comes to Hong Kong. Just taking a little bit, moving on to sort of China. Now, China risk is a big topic. We can maybe address a little bit of that in Q&A, but the biggest risks I think people worry about at the moment are geopolitical, and at the moment it's China invading Taiwan, and the credit market or the real estate market, and whether that will cause a banking crisis or an economic depression. Now, if we think about the geopolitical risk, which I think is the one that people worry about the most, about China being uninvestable, my view is whatever you think of China risk, if you're bullish or bearish, if you're complacent or extremely nervous about it, China risk is priced very differently in different markets. So I give the example of Tesla. Their Shanghai plant is now 60% of their total production, and in an era, if we did see China, lots of sanctions being placed on China, that obviously has a huge risk for the valuation, which I would argue is not really talked about or discounted. Apple still manufactures most of their products in China, even though they're trying to move away. Still more than 80% of their products will be made there, and obviously 20% of their sales are to China. Rio, LVMH, BHP are obviously very, very dependent on China for their sales, and of course they will be significantly impacted by any types of sanctions or the lack of ability to trade with China. And Taiwan Semiconductor, which is a company that's very highly regarded, I think has very low risk priced in for anything that would happen on that regard. Whereas Hong Kong, where the risk premium, and I would argue, is the highest, is actually the place where the risk is lowest because it's already happened. The thing that people worried about, which was China effectively exerting control over Hong Kong, that's already happened, that's taken place. But I think from this point, it's one of the lower risk places to take on China risk, regardless of what you think. What could be catalysts and risks, and what could change people's view on this? I mentioned earlier, Hong Kong is still one of the few places that has quarantine and travel restrictions. They've moved it from 7 days hotel quarantine to 3 days plus 4 days home, and there's a lot of discussion in November of getting rid of that completely. Certainly, anecdotally, that's the reason a lot of people leave Hong Kong, is because it makes it effectively impossible to travel. Although the hotel quarantine doesn't sound too bad, just the cost and complexity of getting, and the lack of those hotel rooms means it's extremely challenging to travel. And for a market like Hong Kong, where people spend a lot of time going in and out, that's been a huge issue. So I think removing that would be important. An improvement in the Chinese stock market would be obviously very good, even though I've said Hong Kong and China are separate places. Hong Kong is the financial center for China, and so recovering China is extremely bullish for that. You can think of it as it's like Manhattan to the US or London to Europe. It's a very the financial activity is very important for the city. And in a way, China, although people are very depressed about China at the moment, there are some positive things going on there. It's one of the few markets in the world that has no problem with inflation, or very little problem with inflation. It didn't do the big QE and fiscal ease that Europe and the US did, so it's in a lot better position. If they did just get rid of their zero COVID policy, then the upside potential in economic activity is pretty substantial. And then a decrease in geopolitical tension, which obviously goes both ways. But I think the current geopolitical tension is obviously extremely high. People are extremely worried and nervous about Taiwan. I started my career, I say in 95, where China were lobbing missiles over Taiwan, and it was the same. People thought a war was imminent then as well. So it's something that certainly can rise and fall. And obviously another risk is that I'm wrong on this China allowing Hong Kong to operate separately, that they do get rid of the legal system, they do make it just another Chinese city. I would argue much of that is in the price, but obviously that's not going to be positive for Hong Kong. And so just in conclusion, I would say I think fears that Hong Kong will become just another city are understandable and misplaced. The valuations are pricing in this very negative scenario already. And so I think for people that are, willing to take on that risk, there's lots of opportunities there. I think the resilience and autonomy are underappreciated in Hong Kong, and particularly in an area of global uncertainty. Having economies that are built to withstand a huge amount of economic volatility and interest rate volatility is a strength, and the upside potential from normalization of travel and reduced political risk is significant. So I just end with this quote from GMO, which is, "You make more money when things go from truly awful to merely bad than when they go from good to great." And I would say that's definitely the position Hong Kong's in at the moment. So I'll leave it there and see if you've got any questions.